So good morning, and thanks for joining in on this workshop, The Decade of Opportunity, Investment in North American Carbon Markets in 2020's. I'm Anant, I'm a senior analyst at California Carbon. I will be presenting in this session, and my colleague Harry Horner, Research and Insights Lead, will moderate the Q&A on this webinar. And Pawan will be joining us as Economic Advisor to CCA Info right into the discussion. It feels great to be here out at NACW, even if it is virtually. Wouldn't you agree, Harry?
Although I think, I don't think there'll be quite so many drinks after the event that you have to live in there.
Yeah, and our team has been coming back year after year, bringing in new updates and new insights in the markets, and especially on the WCI program. This year, we've expanded our coverage to the Canadian Clean Fuel Standards, and I think soon we'll be entering into RGGI as well. And so before we begin, I think it should mention some basic housekeeping rules. In case you're facing any issues with audio or video, kindly drop a message to the host. There's also a chat box and a Q&A window on the top right of the screen. We will answer all the questions in the Q&A round. So for the agenda for the workshop, we split it into 3 sections, which will start off with just a quick introduction to California Carbon and our work. Section 1 then talks about a case for investments in California carbon allowances in the Western Climate Initiative. Here I'll cover some indicators of prospect of investments in this asset class and the correlation with others. In Section 2, I'll provide a brief overview of a forecast model. And then Section 3 will cover our forecast scenarios for 2030 with the outputs from our model. So if you can just bear with me for the next 3 minutes for this short and quick video. And I hope you're able to hear.
Still quiet, Anna.
Mm-hmm.
Maybe you could give the audio.
Let me try playing it on YouTube.
I think it's okay. Let's just go with it and speak through ourselves.
All right. Yeah, so I think we have a wide range of clients on our platform, ranging from compliance entities who use our service to manage their compliance strategy, plan their carbon budgets, and keep a good tab on the market pulse. We have regulatory bodies from both jurisdictions, being part of our clients, and they have a particular interest in long-term prospects of the market. A lot of the new financial intermediaries, investors, traders who coming in new into this market, especially after COVID and the recovery that's happened. We've seen a lot of engagement there, as well as consultants, legal advisories, taking interest in our work. So I'm just going to give you a quick look around on what the site looks like. So this is just a basic layout of our website, and I would encourage you all to take a look at CaliforniaCarbon.info later on when you have some more time, the events. We've got a lot of information, especially on prices of California carbon allowances and offsets and LCFS credits. We also have some, really deep data suites which have some of the historical program data that we've been recording since the past. Especially, a lot of people find interest in, auction bid participation history, which companies have, bid in which auction, belonging to which sector. So on the offset side, we have a lot of data on the kind of conversions that have happened from ROCs to RBOCs in the past. What sort of backlog is there, and a lot of information and insights on these markets. So starting over to section 1, which is really CCAs as a new asset class. This graph is a useful introduction to how the market works. We have a sealed bid auction every 3 months where prices are determined by bids. And at this auction, there is a reserve price that changes yearly, which in 2021 is $17.71. This reserve price increases by 5% plus inflation every year, an increase which is mandated by the California Code of Regulation. And there is a secondary market, a futures market, which is really a futures market both on the Intercontinental Exchange and the Nodal Exchange. And there is an over-the-counter market as well. So as you can see, so far the story has been fairly consistent. The auction price and the front price on the futures market are usually a little above the reserve price, which is really that dotted steps. And due to the mandated increase in reserve price, we think the asset can be seen as a source of steady returns, where there will be consistent, if not spectacular, returns on investment. Although the market is exposed to some amount of regulatory risk and legal challenges. For instance, in 2012, the California Chamber of Commerce filed a suit just 1 day before the first auction, calling the auction mechanism an illegal taxation under California's constitution. While the Supreme Court ruled in favor of state somewhere in November 2013, the same suit re-entered California Court of Appeals in 2016, and while it was finally struck down in 2017. But in 2016, a lot of the auctions undersubscribed, and CCA prices fell below the reserve for the first time in the program. But since then, the market has held itself well against legal challenges, even some of them coming from the previous White House administration. Yet, I mean, the point is that there is always regulatory risk, and more so if the California Air Resources Board moves the goalpost in climate policy or program design. So I think this slide is really to impress upon you the strong market mechanism that's currently in place. We saw substantial price fall in secondary market prices at the onset of COVID pandemic last year. This fall in the secondary market was partly due to predictions of smaller future demand for carbon if the economy shrunk, and partly due to asset holders needing to close margin positions in other exposed markets. The price has since recovered and has returned to its normal trend, slightly above that reserve price. And this exemplifies the market mechanism where unsold allowances from any of the auctions are taken out of the supply in any undersubscribed auction. And they are returned back into the supply only after 2 consecutive oversubscribed auctions. So we did some research on understanding what sort of correlation the asset has with other major indices, and we also spoke to several fund managers, and we got an understanding that many funds are investing in carbon credits, and they state a non-correlation between carbon and other major asset classes, which they feel makes carbon a more attractive part of the portfolio. And as part of our research, we found that the price of CCAs had a strong positive correlation with major American indices, the Dow Jones, the S&P 500, NASDAQ, as well as Dow Jones US Real Estate Index. CCAs were weakly correlated with the FTSE 100, and this was largely explained by FTSE 100's lack of recovery since COVID-19 in comparison to other indices. If we ignore that 2020 COVID drop, then we find a stronger correlation of FTSE 100 with CCAs. With gold, that correlation was weak, but gold was weakly correlated with other asset classes as well. Coming over to fossil fuel resources, when comparing, we found that CCA showed a reasonably low negative correlation with key fossil fuels futures markets, Brent oil, crude oil, and natural gas. These correlations remain if we include 2020 COVID data, even if we remove it. So there is some cross-market linkage as demand for carbon credits can increase with higher production from facilities extracting oil and natural gas in California. The state itself is a large producer for both and therefore any decrease in oil price, possibly due to overproduction by US shale, could mean higher emissions from California facilities. There's, however, a weak negative correlation between the two, and for oil and gas traders, it's possible that hedging with CCAs makes some sense, and we've seen a lot more companies setting up trading desks and finding ways to offset emissions. We know that some of the major oil majors are making investments within carbon offset companies because they recognize that carbon allowances are going to become a more significant part of their expenditures, and they're trying to move fast to reduce the cost of this transition. One example here would be British Petroleum, that brought majority stake in Finite Carbon, America's largest developer of fossil-based carbon offset projects. Here we look at key indicators of market performance, particularly the Intercontinental Exchange. For annualized returns, I've computed the daily price for secondary market front for each compliance period in the WCI program. So on the top left, it's a non-spectacular return percentage, somewhere between 5 and 6%, and it's just above that mandated increase in reserve price by 5% plus CPI. The CCA market has a reasonably low market volatility, with standard deviation of 2 and variance above 4. And in the history of the program, we saw a single black swan event last year that brought CCA prices quite low, almost to about $11.97. And yet we saw a reasonably strong recovery back to pre-COVID levels by the end of the year. For a measure of liquidity, I've taken the percentage of monthly volumes and open interest on the ICE exchange. I've averaged that value for all months of the year. And market liquidity seems to be on an incline. And we're noticing high points around auctions and year end, when the benchmark switch is over. Last year, in the worst month for prices, liquidity rose to about 6% in the market. And we find that, an average of 2 to 2.5% remains respectable for a compliance market. And liquidity is only set to increase, more so with the number of new investor groups that are showing interest in this market. If you look at managed money, which is a CFTC terminology for fund managers and such, in 2015, the proportion of managed money entities was close to zero, and now they make up about 12% of positions in the market. And as their stake in the market grows, they should drive up prices within the futures market, which will have a knock-on effect on the primary market as well. And just in the last 6 months, we've spoken to several new players in the market who are looking to make buy and hold positions in the auctions and trade actively in the secondary market. So here's a look at the primary drivers for CCA prices, which is annual emissions. We're looking at sector-wise historical emissions for California and a forecast for 2020 and 21. Covered emissions in California fallen by 29.4 million metric tons between 2015 and 2019. Electricity generation and imports have seen the largest reductions, primarily as a result of renewable portfolio standards. Transportation, which contributes to over 50%, continues to grow upwards till 2019, and that sees some emissions reduced by 5 million tons. Total annual emissions for 2020, what we forecasted, is expected to fall by about 12.3% or 38 million tons. Transportation, natural gas, and refineries took majority of the hit from COVID, and they're expected to show significant reduction in emissions. And in 2021, even with a likely economic recovery by December 21, emissions will remain below 2019 levels by about 14 million tons. Transportation emissions and refinery emissions could make a full comeback, whereas supplies of natural gas could fall short by 9 million tons from 2019. And this is somewhat in line, at least the natural gas drop is really in line with EIA's forecast for marketed production, which falls to a low point in May, somewhere in May 2021, although the magnitude is slightly lower than what it was in May last year. And then production goes on to increase steadily to a high in November 21. On the Quebec side of things, overall covered emissions reduced by 3.3 million tons between 2013 and 2019. Quebec's transport sector, as was the case in California, contributes to the lion's share of emissions. The largest decrease of 2.3 million tons over the period was observed in stationary combustion sources. And these include public electricity, heat production, petroleum refining, oil and gas extraction, and construction. In contrast, within that period, transport sector has seen a total of increase of 5.6 million tons. "2020 emissions fell by about 8.3 million tons, or 14%, and we expect a strong comeback in 2021, falling short by 2 million tons from 2019. Now to the forecast model. In January this year, we completed the upgrade of our 2030 forecast model. Our previous bottom-up model that forecasted sector-wise emissions based on correlations with few macroeconomic indicators now sits on the right-hand side of this model structure. We've added a vector autoregression model and a general equilibrium model on the left-hand side. The vector autoregression model informs our short-term forecast, and the general equilibrium model is for the long-term forecast to 2030 and even beyond, for 2050 as well. Together, the model is referred to carbon outlook. We also have the model that interplays with LCFS for fuel consumption, and with the offsets model for the offsets forecast. So our 2030 forecast is from this model. The right-hand side is a bottom-up approach, and that utilizes facility level production where possible with total sector production, and combines that with key economic indicators to get a forecast. The left-hand side informs the relationship of price on emissions, while the right-hand side informs that of emissions on price. When put together, they are optimized with an aim to lower the overall spend in the program. And finally, we then create scenarios based on program and then policy milestones. So here are some of the key variables that we consider. We have over 200 variables that we can actually throttle to create, a specific narrative on these markets. So for our long-term forecast, we have run 3 scenarios using the outlook model. First is the likely scenario, then the slow economy scenario, and the heroic climate action scenario. The 3 scenarios are built around potential linkages between different key variables. In the likely scenario, California and Quebec economies are able to overcome the setback of COVID-19 and recover within 2021 itself. The 2 economies then grow at their respective long-term growth trend rates. As for climate policy, there are more hits than there are misses, and we have assumed that the states meet 80% of their climate policy goals pertaining to increasing renewable energy by 2030 and lowering carbon intensity in fuels, 18% carbon intensity in California, and 15% ethanol blend in fuels in Quebec. Energy efficiency in the residential sector continues to improve at the same rates as has been historically observed. Renewable natural gas availability grows, and within Quebec reaches about 10% within the natural gas network. RNG availability also grows in California. Concurrently, EV sales also grows. In California, EV sales move from the current 4% of total to nearly 80% of sales, which means a stock of 5 million EVs on the road in 2030. For Quebec, total EVs on the road reaches about 750,000 by 2030. In the slow economy scenario, COVID-19 casts a shadow on the economy through the mid-decade. The economies of California and Quebec grow slower than their historical growth rates, and due to the slower economy and lack of state budgets, climate action gets deprioritized. Also, due to the economic slowdown, the rapid move towards renewables is affected. The move towards energy efficiency is even slower, keeping demand for electricity and natural gas higher than the likely scenario. On the transportation front, consumers use their existing vehicles longer, and move towards electric vehicles is slightly slower in California, moving from 4% of total sales to approximately 65% in 2030. Growth of biofuels also slows down, leading to only 7.5% blend in Quebec fuels. The third scenario, which is the heroic climate action scenario, California and Quebec economies rebound rapidly in 2021. Both economies maintain their long-term growth rates. The new Biden administration supports climate action and increases US-Canada cooperation on green actions. State policymakers look to accelerate their climate goals, and the move towards greening the grid accelerates with renewables coming on faster, which is about 63% in California by 2030. Inefficient fossil fuel infrastructure is decommissioned earlier, and demand management programs within the electricity sector start to receive an impetus, and correspondingly, building efficiency increases within existing and aging plants. Consumer transportation demand is also reduced with the rise of telecommuting and ride-sharing options. Carbon intensity of fuels in California reaches a 20% reduction by 2030. EV sales rises to 100% of sales, which is about 5 years ahead of the 2035 goal. And in Quebec, there are about 1.5 million electric vehicles on the road in 2030. One of the byproducts of the increased electric vehicles is an increase in electric demand on the grid, which is about 22 gigawatt hours in California, or about 7% of the state's demand in 2030. And due to that increased electricity demand, we expect continued use of natural gas in electricity, at least to meet peak demands. So this graph shows the program cap versus the annual emissions all the way up to 2030. And this is for the likely scenario. There's an initial emissions crossover in 2023, and that's where the annual shortage starts to deplete the bank of allowances that current market participants hold. In 2030, under a total WCI cap of 244.6 million tons, the market could easily exceed by about 83.5 million tons. And the likely scenario, just as a reminder, is an extension of current goals in the program. Looking at a forecast for the three scenarios, in Quebec, the likely scenario doesn't see much change in transportation emissions up to 2030. California, on the other hand, does well by reducing emissions by 23 million tons over the decade in the transportation sector. And it's an interesting point to note that California natural gas and electricity sectors see more reductions in the likely scenario over the heroic scenario. And this is really due to the rate of electric vehicle adoption, which is higher in a heroic scenario. And because of the rate of adoption, there's an added demand on the electricity grid. The heroic scenario will see emissions for both jurisdictions add up to about 317.5 million tons in 2030, which is still exceeding the cap by about 73 million tons. The difference in 2030 emissions between the heroic scenario and the likely scenario is about 10.6 million tons. So coming over to the demand and supply gap of allowances, just before the February auction, we found that the market had a bank of about 490.5 million allowances. This is a direct figure. It's calculated from entity accounts, and the number includes advanced vintage allowances along with current vintage allowances. The aggregate demand supply gap, which is between 21 and 30, for the three scenarios goes like 63 million in likely scenario, then it doubles to almost 109 million tons in slow economy scenario, and only 14 million tons in the heroic scenario. So these numbers are the absolute tension figures, and when you divide this aggregated demand supply gap by the total emissions which are expected in the remaining years, that tension ratio falls to 0.4% in the heroic climate action scenario. So this percentage is the additional annual emissions reductions that the market has to see so that there isn't a price increase. So in saying so, basically that means the higher the number, the higher the tension ratio, and higher the likelihood of an increase in price. Here we see the timing of shortages across the three different scenarios. The annual shortage is the bars, and the cumulative shortage is the line. You can see the impact of COVID in 2020. There's a slight rebound or sort of a COVID relief, and a surplus in the market. And then the likely scenario sees a shortage somewhere which starts off in 22, and for the slow economy scenario, that's in again it's a slightly lower shortage again in 22, and the same for heroic climate action. But more importantly, it's the cumulative shortage that will trigger a price jump. And in the three scenarios, with the likely scenarios, we see that cumulative shortage triggering in 2028, in the slow economy scenario in 27, and in the heroic scenario in 29. And now into the final piece, which is the price forecast. The auction's settlement price effectively hugs the price through the first half of the decade. The price then jumps up to the respective level of the APCR, or the allowance price containment reserve, whereby the market can fulfill the shortage by buying at that unlock price. There's a jump upwards in the likely and slow economy scenario, and the first jump is somewhere around 26, and there's a second jump at 29, which is when the price hits that second APCR. The price jumps in the graph seem a bit sudden, and if you're more realistic, then that price rise is slightly more gradual, because market participants will of course expect a shortage ahead of time, and they will end up buying ahead. In the heroic scenario, the price hugs the price floor all the way up to 2029, which actually would be quite an achievement. And we saw the tension ratio from the previous slide of 0.4, which is again not significant enough to cause a price rise earlier. And at the bottom, I've added the analyzed rate of return across the scenarios. And we see that there's not much difference between the likely and heroic scenario, really because by 2030, those two scenarios close at similar price levels. The slow economy scenario promises a higher rate of return, but really that isn't what participants are going to be rooting for. So to sum it all up, I think CCAs can be considered a safe investment, almost like a bond. And there are high expectations of abnormal returns somewhere in the second half of the decade, once market imbalances unleash the APCR. The asset is a strong contender for diversifying portfolios, not just purely from an investment angle, but also from an ESG angle. But there will also be some amount of regulatory risk, perhaps if CARB changes the goalposts with a new scoping plan, or if alternate markets develop in California. Even more from changes in the political landscape that could redraft those overarching goals for the program. The pace of adoption of new technology will hold the gun on abatement across sectors and the overall demand for allowances. And it's the deployment of capital intensive technologies like carbon capture, utilization, storage can only become more promising as the price of carbon increases in the second half of this decade. So with this, we come to an end of the presentation, and I think Harry will take over from here on the Q&A session. Over to you, Harry.
Yeah, thank you, Anand, for the presentation. It's been an interesting shift of interest in this market. When back in 2015, perhaps when we were presenting at NACW, there wasn't quite so much talk about investors in this market, neither in their impact nor really in their interest. And I suspect there's probably a lot more people that title is relevant to in the audience to this presentation and at NACW and NACW more generally. If you look at the market, look through the slides and the forecasts we've delivered, I think it really represents perhaps one of the more secure sort of effective climate bonds, where you're within pen stroke risk, guaranteed a return of 5% plus inflation a year, and then as our forecast represents, we're quite confident, or very confident, of a tightening of the market across all the scenarios towards the last part of the decade. So from an investor's perspective, you've got that bond, the ESG value associated with it, where when you're buying and holding actual allowances, you're preventing those allowances from being on the free markets. And so you are generally tightening the carbon market genuinely. And then as later on in that decade, there's that significant price rise. So it's then a sort of bond return plus a very probable expectation of a far more significant return thereafter. As ever, with investing, the key will be in timing. Across the calls, we got a lot of people ask us about the timing in this market. If we were to take a position, when would we do it? And I think it's really a balance of perspective, whether you want to look at that initial bond return, or if you're trying to take that later return where you see a step change in prices. But yeah, just to sort of re-emphasize the point on our price forecast there, we show two steep step ups in prices. We do expect that to be smoothed over as an increasing number of players in the market internalize forecasts like these and internalize the growing shortage in the market. The real key to this decade will be in determining and discerning the timing of that, something that we intend to focus a lot of resources on. So I'd like to bring in Pawan, who has been a very helpful, very useful economic advisor and has worked a lot on the forecast for California Carbon. Pawan, while Anand, I think, looks through some of the questions on the Q&A, and do please keep adding to those. For you in leading this modeling effort, what do you think were some of the most surprising outputs of your work that perhaps raise eyebrows the most often when we do forecast calls?
Gosh, several things actually. So I think one of the key aspects with respect to modeling, and I think one can usually think of a market, a regulated market such as CCAs as being a straightforward demand supply modeling. But I think one of the biggest challenges that we had and continue to have actually is the piece that Anant referred to in his presentation, which is while a lot of us are familiar with the impact that emissions might have on price, but what's the impact that price is going to have on emissions? And therefore, how do you begin to factor in, what is the likely price and how do people make investment decisions on projects, or people make investment decisions related to whether they should be upgrading technologies, so on and so forth. And I think that has remained and continues to remain one of the tricky portions of the modeling. And I think, to be candid, given the fact that this market has now been around for a decade now, really, almost, there's a fair bit of data, and so you can begin to tease out relationships, especially using a few techniques on how some sectors are responding to that price. And clearly, we've seen that the electricity sector has been perhaps the we've seen the biggest elasticity in that space, and now we're beginning to see some movement. And I think I see a question also related to LCFS, which I'm sure we'll get to, but we are seeing some interplays between some of the pricing that's happening in the LCFS market and how the pressures over there, and how people on the refinery side and oil and gas majors on the refinery side, the impact or decisions they're making over there are going to be impacting this market. So again, I don't want to just talk ad nauseum over here, but I think the key aspect, I think the trickiest portion and the most surprising portion, and the piece that can challenge us, is really that impact of price on emissions.
Yeah, and I think coming to those questions now, I will say to the audience, do keep adding to them, and we will definitely work through all of them as they stand. Let's go straight to that question on LCFS, on the LCFS market, since it came up. We've modelled both of these quite extensively, and have looked, and I suppose the way we model this, our transport sector work is really shared across both models, as we see the interoperability of that. Could you color that a bit further? How significantly the LCFS program, as an auxiliary program to cap and trade, how significantly that will impact cap and trade over the next decade? And secondly, what is the outlook for LCFS? Or maybe firstly, what is the outlook for LCFS, and then how that will impact the transportation sector and cap and trade?
Sure, and I think the LCFS market, there's clearly a significant interplay, and we're seeing how that plays out. And I'm just looking at the question. The question is also referring to the price in the LCFS market is much higher than in the cap and trade market. Let me just spend 30 seconds first outlining why that is the case, and what will and that's likely to color how the LCFS market interplays with this market. So when we're discussing the cap and trade market, and we're discussing the price of allowances, we're talking about price of allowances of the entire market. So the cap and trade market today consists of give or take about 320 million tons of emissions in California, and about 50-60 million tons in Quebec. So when we're talking about allowances, we're talking about all those 360 tons, give or take. When we're discussing the LCFS market, there the pricing is really happening on the margins. So the transportation sector, which is about half of California and Quebec, which constitutes about, again, 150 million tons, give or take. You are in the LCFS market, we're not talking about 150 million tons as much as we're discussing what is the reduction in carbon intensity, and therefore we are discussing the marginal prices, or I shouldn't use the term marginal prices. I need to use my words choose my words carefully here. But we're discussing the incremental the pricing on the incremental change on carbon intensity, and the pursuit of And the goal with respect to the LCFS market is a reduction in carbon intensity of the fuels. And therefore, when we're discussing the price of the LCFS credits, we are really discussing what is the additional cost that I need to pay for a credit to get some cleaner fuel. So I'm not necessarily changing the entire 150 million tons of emissions causing fuel as much as I'm changing, what's that additional delta that I need to introduce. And therefore, these two markets are different in terms of the way the carbon credits are priced. They're not the same things. They're apples and oranges, which is why the difference in price exists. And just to reiterate, in the LCFS market, therefore, it is the incremental delta or the incremental change of carbon credit that's getting priced, or carbon emissions that's getting priced. Whereas in the allowances market, it's the whole piece that's getting priced, and that's what causes the differences. Having said that, the LCFS program is also obviously causing a cleaning up of the transportation sector, and we're seeing a lot of interest of whether it's people upstream, and therefore the refiners or the oil producers, so on and so forth. They're investing in a number of projects looking at ways in which they can reduce the carbon intensities of their fuel. We also have a significant number of credits that are getting parted for electric vehicles, and that piece is getting an impetus. And the implication there is that as the transportation sector gets cleaned up, that obviously impacts the cap and trade program. And just to color, and I think Harry and Anand, you can also color this piece, which is that these two programs, the LCFS and the cap and trade program, are just two amongst a number of other programs that the state of California has to move towards its climate change goals. And so they are meant to interplay with one another, and we do see how that interplay is actually now shaping, especially the transportation sector, between the LCFS market and the cap and trade market. And so as the LCFS market meets its goals, we will see the transportation sector emissions in the cap and trade market falling as well. Again, I'll just sort of pause over there and
yeah, I mean, I'd second that and color a little bit about the importance of recognizing all of those climate programs as an investor coming into this space. You're not really able, I don't believe you're really able to focus solely on the cap and trade market and look at the trends there and then be able to build out a full picture of that market's future. And that's one of the reasons that, why we've structured the product like we have, that includes coverage of those other regulatory programs, including LCFS and beyond. And it's why, we have to pay such close attention to ARB's regulation of cap and trade and all the other associated programs, because they do all interact, and they all interact in deciding the cap and trade market price. It's very important to have a holistic understanding of Californian emission reductions to be able to invest wisely, I think, in this cap and trade market. So coming to some of the first two questions. Firstly, what is the total value of CCAs traded? Could you provide some idea of liquidity? And then after that, we'll come to some points on offsets. So Anand, to put you on the spot for numbers.
Yeah, sure. So I think in 2019, we had about 900 million trades that happened. And with an average price of, say, $17, the total traded value comes out to about $15.3 billion US. And in 2020, the amount of trades, the volume that happened was much more significant, about 1.3 billion trades that happened. And at an average of $14.8 US, I've taken a low point of $11.97 at the COVID crash, and a higher point of 17 above. The total trade value is about $19 billion US within 2020.
So just to be clear, those statistics are on the secondary market, which is the secondary market for allowances through the ICE exchange.
Yeah.
Not including auction values. Is that correct?
That's correct. Yes,
Yeah.
That's correct.
Otherwise, I mean, we can look at it from a sort of total annual value of the market, and then you can, combining Quebec and California, there's about 360 million, as Pawan mentioned, 360 million tons And then if you were to multiply that by the current market price of $18 or so, that comes out of about 6.5 billion. So that's the sort of annual value in the market at any one point. And then, as Anna mentioned, those are the annual liquidities. It's around, we've seen liquidities of around 3 to 4 times the total market value over a year. So I hope that gives a bit of perspective there. So the second part of that question, does the total volume issuance of carbon offset credits influence CAA transaction volume and vice versa? So because, in my experience of analyzing the market, the allowance market is really the clear leader in this dance between the two markets, representing for the last compliance period 92% of the market with an 8% limit on offset usage, and that's now come down to 4% for the next 2 compliance periods and 6% thereafter. So it's the allowance market that dominates prices of offsets, and will provide the ceiling for that. And then within that, on a finer level, you then have the net supply demand of the offsets market itself. The demand side of the offsets market is clearly led by 2 factors. Firstly, the total emissions of the cap and trade market, and secondly, by the uptake or choice of usage of offsets for compliance. One of the trends that we've seen consistently is that there's very strong usage from much larger compliance firms, where if offsets have been trading at a 15 or 20%, traditionally have been trading at a 15 or 20% discount to allowances, then the sort of savings you can make by using 8% offsets are very significant when you've got a large compliance. Whereas when you've got a smaller compliance obligation, those numbers come down, and it maybe comes to the point of a decision break between using offsets or not. And so therefore, we've seen lower demand from smaller compliance entities. From the generation side, which is the supply part of the net supply demand equation for offsets, that's been, as you can see, there's a huge amount more information on this on our site, but it's been dominated by forestry offsets. One of the biggest issues at the moment is AB 398, which introduced rules, firstly decreasing the usage limit, as I've discussed, but secondly, introducing a rule called direct environmental benefits, or DEBs. And the DEB rule states that at least half, or only half, of the offsets used for compliance for any individual entity can be non-DEBs, or not directly environmentally beneficial to the state. And that effectively means that only half can't be offsets that were originated in California. And that's been one of the big leads and big influences in the supply side of the offsets market, which has meant that a lot of projects outside California we're seeing far fewer new inflows of offset projects from outside California. And we have a fully developed model for this over the next 10 years, looking at the next supply demand and generating a price forecast of that. So do check our insight reports and offset price forecast if you want to bring that in. So directly answering the question, yes, the more allowance demand needed, the more offsets you would also expect to be bought. And the larger the price discount of offsets, that's widened a lot. Offsets are currently at about beyond 30% of a discount to allowances. The greater incentive to use offsets within compliance, and so we expect their increased demand. The next question is also on offsets. On slide 22, were the shortage scenarios considering offset credit supplies as well, or offset credit supplies have a minimal impact on the carbon market? Anand, maybe we could skip back to slide 22.
Yeah, sure.
I can actually step in on that very quickly. I think there are a couple of things, not just slide 22, but even the tension numbers. Maybe that slide may be more appropriate. But so we have taken into account the offsets. And Harry, I see a couple of other questions, maybe where you can color color some of our research in terms of how people have used offsets. So what we have done in the modeling there is we have taken into account, or we have assumed that there will be past behavior that continues into the future with respect to utilization of offsets. And Harry can color some of what we have learned in terms of how people have been using offsets. And as you can see from just the data on the left, which is the demand-supply gap in the likely scenario being 63 million, this does take into account the offset supply. If that were not there, the demand-supply gap would be higher, and therefore the offsets do play somewhat of a tempering role in terms of or reducing or helping temper the price, or helping temper the demand supply variance. If it weren't for the offsets, the delta would be much higher.
So the short answer to that question is that yes, we have definitely included the impact of offset credit supplies and offset usage within the forecast. It's integral in deciding our price forecast. We also recently did some research through the 2030-2040 period, where there may well be revisions to offset regulations and how many offsets can be used and in what manner by ARB. We modeled 3 scenarios there: a max offset usage where we increased the usage capabilities, a continued policy where we remain at 6%, and then where offsets are effectively scrapped. And those represent the 2 extremes in the middle path for where the regulator could go on this. And we saw a difference of about 3 to 4 years for when prices make significant jumps between the 3 scenarios. So they really, in a way, over the next decade and the decade beyond, offsets really do represent the throttle for the market, and certainly the throttle that is most potentially at hand from a regulatory standpoint. There's a question here from Zain Haxtema. When you refer to the secondary market, are you referring to the market for RBOX? So no, the secondary market in this way means the market through the ICE, or through the exchange for allowances, the primary market being the auctions market that occur 4 times a year. Do you believe the same pricing trends that have been discussed, 14 to 15% return on investment, will apply to RBOX as well? So broadly, the answer is yes, and maybe even with higher percentages, because offsets are at this point starting from a much lower base at a slightly more than a 30% price discount. That also addresses a further question we have, stating that offsets are about 8 to 10% cheaper than CCAs, to their understanding. Just to provide more clarity on that, from the front page of our website, we aggregate broker prices for offsets. There's no exchange, or there's not many exchange prices for offsets. A lot of the business is done through brokers, and we aggregate those broker prices. The current CCO3 price, which is 3 years of invalidation, stands at $12.51, and the current front for the current vintage is $18.10. So it's about a third less, as I said, 35% less as we stand, which provides a huge incentive for offset usage. One of the dynamics in the offset markets, as I mentioned, is DEB's, direct environmental benefits. And what we do see is a splintering market where DEB offsets actually end up $3 to $5 more expensive than non-DEBs by the end of the decade, purely because of their relative supply pools. California being a smaller state where you can originate offsets versus the rest of the US, where there's a lot more capacity. There's both more stock currently there, and also then there's more capacity to generate new projects as well. Especially where compliance offsets, I've just mentioned, are trading at $13, whereas voluntary offsets are often trading around $5 to $7, maybe $5 to $8, depending on quality and type. So that even though there may be greater restrictions for generating a compliance offset, there may also be greater benefit. So Anand, one of the perhaps closing questions for you, why is there such a large difference between CCAs, RGGI, CMEs, and CME CBL futures?
Right. So I think I can speak for CCAs and RGGIs. Those are the markets I've been looking at. So I'm guessing this also refers to the price difference between those two, between the instruments across those two markets,
and also the futures as well on the CBL market.
Mm-hmm.
Change.
Yeah, and so the way I see it, I think it's the way that the credit mechanism works. I mean, it's how the units work. So within the CCA market, it's a metric ton, but in RGGI, it's a short ton. At the same time, it's the verification standards for the credits, which also adds in a portion of the price. So in combination of a lot of other factors as well, it makes a certain sort of price difference between each of these markets.
Yeah, thank you. So I think we've addressed the majority of the questions and also come near to the end. We've just got one question. What is your estimate of DEBs on forest carbon offset projects? So as I mentioned, we expect DEBs to end up around $3 to $5 higher than non-DEBs by the end of the decade. We have released a specific report on this. You can well request us for access to that. I think it's probably one of the most detailed reports out there on the market that specifically look into offset pricing over the next decade. And then maybe if you had a few more slides at the end, I don't know if you had any further content to run through. I would just mention that we're doing another webinar on the which also which really looks at clean fuel standards across America and Canada, and looks at their interoperability and really looking to cover that increasingly complex mosaic of markets that we're seeing emerge on the clean fuels space across North America. And do you have further slides to show?
No, I think that was it, Harry, and perhaps some closing remarks.
Yeah. So thank you all very much for attending. If you do want to speak further about forecasting or our other research and insights work, then be sure to ping either one of myself, Anand, or Pawan. We'd be happy to catch up with you in the networking sessions. Otherwise, just send us an email, and we're always open for a chat and to discuss perspectives and see where your informational needs lie. But Anand, thank you very much for the presentation. Thank you, everyone else, for all of your questions and your attendance. And yeah, I look forward to catching up with you over the rest of the conference. Thank you very much.
Thanks, everyone. Thanks, Pawan.